I think it's been great that it had a very good jump, good for the overall IPO market, certainly getting us out of the doldrums post the lift aftermath after its pricing. But we rate Pinterest at a 48 on our scale of 100 for the financial health rating. That's right in the middle of the pack. That means it's got a reasonably low default risk in the short term, but it's got an 18 core health, meaning its medium-term prospects really need to improve over the medium haul.
Were you surprised by Zoom? I mean, it priced higher than its range, which had already been lifted, and then it finished the day up more than 70% today.
Well, it was a great start for sure. But I think it's indicative of a couple of things. It's an enterprise play, not a residential one, if we can. But it's a profitable company, and our rating on it is a 64, which is very high with a 38 core health. That combination is probably the strongest of any of the tech IPOs we've seen in a long time. So it's a smaller company, and it was a little bit overlooked coming into today. But the bottom line is it's extremely strong, and I think it showed that, and the investor reaction was there accordingly.
Brian, which of either of these do you think has had an overdone jump on day one?
Yeah, really interesting. First, I have to say to James's point, I'm going to be the grumpy guy here. I have to say that up front. I don't give these guys a great rating. I really don't. Not a negative 48, but definitely not that high. And here's why. They're still losing tons of money, and we have to look at the reality. I was a tech entrepreneur for 20 years. Guys like me were getting a pass all the time. We can lose tons of money. We're growing well. But the bottom line is I don't think the performance is good at all at the financial level. We have to look at that.
Which one are we talking about there, Brian? Both or
both?
Just,
yeah, both of them. That's a good point. Although I will say to James's point, it's a good question. Zoom is at least making money. It's great. But remember, they're trading at 24 times trailing sales. Unbelievable. To give you a benchmark, when a little unknown company called Microsoft went out, they traded at 4 times trailing sales. So just think about that scale. So Zoom, I like them better. Great question. But I still think these guys are way overpriced. I really do.
How do you think this sets us up for the big boy that's coming probably next month, which is Uber, which is expected to be valued at $100 billion?
Yeah, I mean, look, I think to Brian's point, the quality of the company and the actual trading level and the now market cap, they're pretty separated. There's a lot of sentiment, a lot of momentum investors who really push these up. So Uber is the one everyone's been waiting for, and I think it's going to get a fair amount of attention because of it. But from a financial health perspective, it's actually worse than the other two we were just talking about. I think.
Is it better than Lyft?
I think it's actually, from a financial health perspective, it's almost identical to Lyft once you adjust for the one-time benefits it got from sales of assets in Asia and in Russia.
Brian, what's your take on Uber?
Again, good company, good business model. Sales are great, but, they're losing tons of money. That's the dead cat in the room. We've got to look at this with any tech company. It's been going on for a number of years right now. To James's point, the IPO market tracks real well with the overall market. So to your question, I think these guys are going to do okay. But if you look at it like Lyft, they went down. I mean, I think they were overvalued. So I think Uber is overvalued, losing tons of money, good company. My issue is around the valuation. I mean, really, that's it. And remember, 80% of these guys going public right now are losing money. And that worries me because in a down economy, and things that go up do go down, those companies will get punished very quickly.